Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for January 30th, 2023. We are recording this at 1 p.m. Eastern Time, and this is episode number 374. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and today I've arranged for Sonny Harris and Michael Filighera to join us again. And the option professor is back to moderate, so I'm going to go ahead and turn it over to him.
Sounds great. And big week ahead, guys. We've got all kinds of information. Tomorrow, we're going to start with the employment cost index, which last year was running at about a 5% or better clip. So it'll be interesting to see if that backed off or not. And then, of course, we've got the Fed meeting. And then we've got on Thursday, we got the three big guys, Amazon, Apple, and Google, announcing their earnings, which is about 13% of these indexes. So we're definitely going to know a lot more by Friday than we do now. Before we get started, let's introduce ourselves. Sonny, could you introduce yourself and your company?
Hi, I'm Sonny Harris, and I have a website called moneymentor.com. And I've been trading for 42 years and have developed my own indicators and strategies, which I make available to listeners. I'm a mathematician and a trader and a programmer.
And there's those Sonny bands, which are proprietary to you that you're going to get into. I forgot to mention the good news about today is we've got two very distinct technical people here. Sonny has got her Sonny bands, which are extremely interesting and effective. And then Michael Filighera will give us, I hope, more on the Fibonacci and the Elliott wave. So I think we're going to get a great technical look at stuff today. Michael, can you introduce yourself and your company?
Sure. Good morning, good afternoon, everybody. My name is Michael Filighera, and my websites are tradershelpingtraders.com and logicalsignals.com. And I am an analyst and a trader, and I have a YouTube channel where I provide my Eye of the Storm podcast, which is a once a week big picture update, and also daily coverage of the Elliott wave update for the S&P and the NASDAQ 100.
Okay. Now, we've had a stampede into these markets here in the first month of the year, actually since November. And they've gone into U.S. tech, they've gone into Europe, they've gone into emerging markets, and they're going into China and Pacific Rim. So we're going to try to figure out if this is going to continue or if they have discounted a little bit too much too soon. So before we get started on Monday, we always say the S&P opened today at anybody have the exact opening? Looks like, is it 40.49? Did it open at?
I have it at, let me see.
Yeah, this says 40.49.27.
Yeah. Okay, so let's use that as a gauge. 40.50, let's call it. From 40.50, where do we close on Friday? Above, below, or the same? We'll start with Sonny. What do you think? And what is your confidence level?
I think we're going up to what I call the next attractor. I call all kinds of interesting things attractors. And I think we're going to go to at least 41.29, which isn't much, but it's better than down.
Yeah. And your confidence level is about?
Oh, about 60, 70% maybe.
Yeah. More probable than not, but not 90%.
No.
Michael, your call and your confidence level?
Well, it's sort of like playing Russian roulette at the moment, I think. Like you mentioned, we have so many things, the largest being the Fed decision on Wednesday, and that'll be followed up by, the trifecta of earnings reports on Thursday. So my thoughts are, I do expect the market to actually, that's a beautiful target that Sonny mentioned, because that's exactly the target I have. Mine's 41.32 up to 41.50, but it's just, they could hit that on Wednesday and be all done. So by Friday, it's a mixed bag. I'm going to say lower, and I'm going to only a 50% because we're just waiting on too much information.
Hey, there's a lot of 50%. That 10-year note is at 355. I think if we started seeing 335, the party's over on that side. And if we started seeing 360 or 380, the party's over on that side. So
Absolutely. You got the 10-year, the 30, they're all doing that same thing.
Yeah, so they're right in that
hovering right
middle
around
here,
there.
and so it'll be
Yeah.
very interesting to see what goes on. Now, Sonny, why don't you throw up your Sonny bands now, and then you could put a little picture behind your thoughts, and then Michael, get ready with your screen to maybe show us how Elliott and Fibonacci is coming into your thoughts. So, Sonny, let's start out with your Sonny bands, and as they say at court, let's see your evidence.
You see my screen okay?
Yep.
Okay, so there's a chart with, this is the ES on it.
Uh-huh.
And I had the Dow on there just a second ago when I was looking at where we're going.
Uh-huh.
No, I guess I didn't. I had the ES on there. And I have right here is what I call an attractor, which is it attracts price to it. And there's another one right there was the one I was mentioning. Notice that that's right at the top of the Sonny bands, the green lines that go on the top and the bottom. The two extremes are the outer Sonny bands. And that's where I think we're going, right there.
Now, if we were to revert back to the mean a little bit, where the gold and the purple are kind of meeting down there, what number does that give you?
That gives me 39.77.
Mm-hmm. Yeah, because there are a lot of moving averages with a 3,900 handle. So if the news didn't go the way of the bulls, going back towards those moving averages,
then we're definitely going for that 39.77.
yeah, that would make some sense too. So that's why it's a little bit binary this week, huh? It's either going to be go up and blow out the rest of the shorts and get the rest of the sideline money going, or it's going to be all these people that bought in or want to get out the movie theater at the same time.
So it's either going to go up or it's going to go down. That's what you're saying?
Well, I'm just saying it's binary much more than usual.
Yeah, it is.
Because of the news and because of where we're at.
Yes.
Yep.
You know, because we are a little bit extended away from some of the moving averages. Look at all your other bands that are way underneath the market.
Yeah. Oh, yeah.
So we are extended away from a lot of those bands. So if the news
and there's another attractor right here down at the bottom band.
There you go. So I mean, like I say,
if
if they come out and get real hawkish, if this employment cost index shows that the labor costs are still going through the roof, and other factors, you know, there's certainly enough people who've made money between November and now to take some profits. You know what I mean?
Yeah.
So it'll be interesting. But like I say, if it comes out dovish, and if it comes out that you know, Google and those guys all made their numbers, and they don't give guidance that scares anybody, you know, obviously the path of least resistance has been up, right?
Yep.
Yeah, but I think, you know, those companies could come out with good earnings, and the Fed can say we're going to increase rates again, interest rates, and so one will throw the market up, and the other one will make it go down.
Well, Larry Summers was mentioning this employment cost index, which comes out tomorrow, as the gold standard on labor, in that it really gives you an idea of what labor is costing. And like last year, it was 5.1%. So obviously Fed funds is underneath the rising cost of labor. And that's a relationship that the Fed may want to change. You know what I mean?
Mm-hmm.
So it'll be interesting. But, you know, according to the bands, you can definitely see how it could run up to that higher green line there. And it's just that the majority of the lines are underneath, and there's getting to be a decent amount of real estate between those other lines and where we're trading.
Very good.
So we'll have to see that. It's going to be very exciting, but like I say, the way the flow has been, is to the upside. Michael, can you share your chart and give us an idea of what the Fibonacci's and the Elliott's are telling us? Yeah.
I sure can. Let's go to this one. That is the one I want. Okay, you should be able to see my screen.
Yep.
Okay, I'm first, I'm going to leave up my hourly. And the way I was counting it, we still had a small fifth wave, but turning into a much larger fifth wave that was breaking down. I mean, in terms of it was subdividing very cleanly until this morning. I was expecting a small pullback after Friday's high was reached at 4,100, but that got smashed. And now it's turning into something much larger, which puts that high and additional highs in jeopardy on an Elliott basis and also on a fib basis. Now, considering that this was larger than I expected, this was larger than I expected, and the market absolutely rallied right off of them. We started to, and then we pulled back down, and I'm going to be very interested to see what the balance of the day does. As we were discussing, I think if the market continues to drop down from here, it's all over. I don't, it's going to lead into probably a hawkish view coming out of the Fed. I'm also getting a lot of rumblings from some of the larger firms and a lot of the larger analysts that 4,100 to 4,200 is just not sustainable. They may try, but it's not sustainable, and it would provide a turn that will end up being massive in the markets. That's what they're saying. I think that ultimately, if this all pans out the way I think it should, this is my target, 42. And that would then complete this fifth wave. And then let me just pull this out one notch. And then it completes this intermediate wave 2 that I've got going on here. Now, again, I got all my fibs in there, so it's kind of blocking it up. But there are people that are talking that it's going to go above 43 eventually.
Well, because if you took the measurement, if you took the measurement of 48.10, which was the top, and 34.91, which is the bottom, and you took 61.8%, you're at 43.06. So some people are probably using that number as a guiding point.
I agree.
And again, we are in this cycle. There's a cycle between the end of October of last year and April of this year that goes back for a long time. It's the second year of the presidency going into the third, and that has been an up cycle pretty much every year that I look back since 1970. So I think you got some cyclical stuff happening here too.
Right. And I definitely do not disagree with cycle work, because I think we all depend on established cycles to continue to repeat themselves. But I think we've had a lot of disruptors to the cycle.
Yeah.
And that's now coming into play. I think you brought some good points on what could happen. It's like we're still coming off of a pandemic. We're still doing a lot of things. And what you mentioned, as far as like being within an inflationary period, that what you mentioned, like employment cost, that's major, that I don't think people are really looking at. So I want to thank you for bringing that in, because I think that's a very, very important factor for people to realize, that the one thing the Fed has not been able to do is more people are going back to work, which a standalone by itself, yeah, that's positive. I like it. More people getting jobs, having money, et cetera, but it's inflationary.
Mm-hmm.
And if we don't grasp onto that, so that number that you talk about tomorrow, I was already aware of, but I'm glad you mentioned that, because it's going to give so much clues to possibly why we had Fed governors and Powell himself coming out and saying, hey, do not get too excited about this rally.
Yeah, because it is based on a lot of very hopeful ending of the Fed. I mean, where's the evidence of that? If the employment cost index is very high, and the money supply, the M2 money supply, which I've been watching since last year, and it's been going in the toilet. It's actually negative growth on M2 money supply. And in history, you don't see the asset prices going up too far if the money supply is tanking.
Right. We got that. We also got the Fed has got still, I think they still have like $5 trillion they need to get off their balance sheets.
Yeah. So
and if they're not able to do it in the methodology that they're using, what's left? They debase the currency.
Yeah. That's why it's going to be a very volatile year this year, I think.
Absolutely correct. Yes, I agree.
Very volatile.
I agree.
Sonny, when you are looking at the Sonny bands there, can you put your screen back up, and we'll take a look at, the methodology a little bit. Maybe you could explain it to the laypersons, how you come up with these things. Yeah.
Well, they're kind of magical. They're based on the purple and gold lines in the middle, which are my dynamic moving average. I figured out many years ago that whipsaw is cause whipsaw back and forth, and you lose money. You make money in a trend and you lose money in the whipsaw. So I developed some proprietary mathematics that took me about 18 months to research and come up with, that keeps this moving average from whipsawing. You notice, you see it comes down here and it doesn't whipsaw, and over here it doesn't whipsaw, it just stays steady. And that's the basis of the Sonny bands, is this dynamic moving average. It calculates its own lengths, like length 1 and length 2, short length and long length, whatever you want to call those two moving average numbers are calculated internally to the dynamic moving average. So
got you.
then the green and teal lines on the outer, upper outer and lower outer part of the bands are 1.2 and 2.0 average, 2 ranges away from the DMA, dynamic moving average. And that seems to contain price really well.
It does. It definitely does. And you know what I was thinking is Thursday we're going to have about 3 stocks that represent about 13% of these indexes. So obviously how they are going to go is going to have probably a decent effect on the markets. Can we look at Apple, Amazon, and Google and see what your sunny bands are showing?
Apple, well, this is what I call a sunny band sell signal right here. You see this blue candle went up above this upper sunny band, and then we've got a red candle inside. That's a sell signal if confirmed by price action tomorrow. So we have to wait for that to see if that's actually a sell signal, but gold is still on top. That's a really questionable, it's a scary trade there because gold's on top and it's expecting price to go down, but it may not be confirmed tomorrow. And we've got this 200 period moving average right on top of there. Good chance it's going to try to break through that too.
If it does go weak, where would you start thinking it's time to pull the ripcord? Because it has had a pretty good run from 125 up to 140, almost 150 here. So
well, if it goes down tomorrow, I'd be short.
Okay. So if you see a red number under 140 or something like that, that would certainly not be good.
Right.
All right. So there you go.
Apple, Amazon.
Yeah. Amazon is the next one.
Amazon is just going on down.
This is Amazon, AMZN.
Oh,
No, it's AMZN. Yeah.
One more.
Amazon's going on down. Oh,
Yeah. Yeah.
It's a bad time for drugs, I guess.
yeah, it is.
Or a good time.
Yeah.
So Amazon here looks like it's going on up. It's pushing the outer sunny bands up, and we're heading for the 200 on this one.
Yeah.
So we're still moving in that direction.
I had a huge buy signal on Amazon when it hit that low price that it hit. There's this real long-term average that I've been looking at on it, and it came down and touched it, and then bam, did it take off of that. It's I think it's called the 120 EXPMA, and it came in at around $87. And when it hit the it went into a little lower than that, and then boom, it's bounced off it pretty nicely. So
and right there's the sunny bands buy signal.
Yeah, you got it right around the same spot. Yeah. So that was an excellent entry level right there. That's why, working with these lines sometimes is pretty heavy, pretty good, because these entry levels, if you put your sell right underneath it, is not too much risk. And then if it does turn, that's a pretty good pop.
Just exactly.
Yeah, I'd rather be buying against that green line than buying now. You know what I mean?
Yeah.
Yeah.
Well, but when things are going up, it's a good time to buy.
Oh yeah, at least
momentum.
Yeah.
I disagree with trying to pick bottoms.
No, right. I agree. But as far as, being able to put a stop pretty close here, it could pull back to 95 for all we know.
Could easily. Look, right there's an attractor.
Yeah.
It hits it over and over and over again.
Couple of bucks away.
Yeah.
How's Google shaping up? GOOGL, I guess, is the main one.
Yeah. Well, we've got another attractor up here right at the 200-day moving average. So I think we're going on up to the 200 on Google.
Yeah.
I think it'll be surprising because it doesn't look like it's going to do it.
Right.
But I think it will.
Yeah, like I say, the flow of traffic is to the upside. So if if they get anything to grab a hold of, any trepidation that they had today going into the thing, obviously you know, if you go to a no seller environment, the algos just hit the side that has no liquidity. And that's how you get the volatility either way. In other
Mhm.
words, once they can see there's no offers for whatever reason or no bids, then they hit that side as hard as they can, and they force, you know, they cause the volatility, because, you know, it ends up being an order imbalance with a ton of people buying or a ton of people selling, hitting that side of the market that's weak.
It's true.
So anyway, Michael, do you want to take a look at these three stocks? Again, they're very important stocks coming up Thursday. And what's your wave and Fibonacci's telling you on it?
Let's see if I can get that to show my screen again. Let's go over and first look at Apple, because I believe I do actually have a count on it, which now I'm going to have to change, because you can see, like everything else, it is putting in a tremendous rally right off of that 125. So I haven't updated this in quite a while, since actually October. But if I had to say that this completed and now we're in this upswing, but that would have been for the downside. Let me just redo some of this. And if I'm just going to do straight fibs coming up, I'm going to run them from there to there. So 50% is 150, and then with 618 is 156. And I think anything above 157 really opens the door that it can go up and start testing the highs. Now, current environment, current of what's everything going on, interest rates, et cetera, could put the kibosh on everything. But Apple, as they're now talking about, is the one company where they have not lined up to say we're laying off X amount of people worldwide, et cetera, and where actually the CEO took a $49 million cut in his salary. So that could be perceived as like, wow, that's very gracious, et cetera. And we already know that Apple is the largest retail stock in the world. And so again, unless they say something really contrary to what everybody's already believing, I think, yeah, that it's going to continue to go up. It may do it real quick, spike fashion, and then just start the down cycle. Because one thing that I do say in terms of not only an Elliott wave count, but just what economically is happening to the country, or more to the economy, Apple is not going to escape that. So people say, well, Apple doesn't borrow money. It's like, they most certainly do. And so if their borrowing costs are going to be higher, or their employment costs are going to be higher, then they're going to feel the pinch. So I think that, yeah, we could spike, but I think then still we're going to pull back. I mean, that's pretty straight line up.
Michael, you see the trend line that comes from your B, where you topped out the fib lines right there, down the next highs? No, not that one. That's the fib.
Oh, you want me to go to this one?
Yes.
All right, hold on. Let me put that in there for us. If I just go from here,
And all the way down to current across that. Down.
right, all right, to this one.
No, go down off the recent highs. There. Whoops, too far. Right there. And see, we're above that. That's a very bullish sign to me.
It just kind of took it away. Okay, let me do this
Right
again.
there. That's good.
I gotta anchor it here.
Oh.
Okay, there. So when it broke above it.
Yeah, that's bullish. In my book.
Okay. Because it broke the
'Cause
channel.
it broke the trend line, yeah.
Broke the trend line, yeah. And previously it went up, came back down below it.
Right.
And then continued lower. So on that basis, then, would you consider, if it got up here, touched inside a reverse, that the reversal would not get confirmation until it came back down and broke that trend line?
Yes.
Okay. Yeah, that's fair. Because I think even in a corrective basis, it's going to come down below that.
Do you?
So yeah. So there's Apple. So even on an Elliott basis, it has in my opinion, on an Elliott basis, it still has some upside potential, but it needs a pullback. It may continue in the upswing, but it needs a pullback. It's kind of on my daily, you see it's turning lower off of nearly overbought on a daily.
Mm-hmm.
We still have the 200 sitting right above it at 148, almost 149. See, as long as that continues to go flat, that puts the brakes on a rally. But all the others, and still you would think that this is on the daily. So, it gets a little weird. The 50 is turning higher, but the 20 is yet to cross the 50. And that's got to be another that has to occur to get our moving averages in alignment and getting ready to start breaking above that 200.
So it hasn't finished its death cross yet.
No, correct.
Yeah.
I would put that in there as well. So how that bodes for what they're going to report on Thursday, let's flip a coin, because it's really what it's down to. But I really, even though our indicators are kind of suggesting we should continue to go higher, we're looking for higher. How many times recently have we seen where it's just like, no, I don't care what you say, it turns and it just dies. And it does the opposite. It throws the surprise. And so I can't discount anything. I think initially, I think we can get a spike. We can get up to here, maybe even up to here. The way that they come after stocks now, yes, I can see it. But I think then it turns and it does correct. So, and then I'd have to have that upper level to really try to determine where we're going to find support coming back off. Initially, I would use my moving averages to where it could come back to. And if this 50 is really being a laggard here, it'll end up being support on the way back. And it'll be like a magnet.
I just looked at the ES on a weekly basis, and the Sunny Band says it constrained and going down next.
Wow. Okay.
Yeah. So we're in some kind of a strange bear market, sideways bear market.
We are definitely, strange is the optimal word right now.
Yeah.
We are most certainly in a very bizarre, strange time. Because, and I obviously don't have anything here on Amazon, but that doesn't mean I can't look at it. And again, just off of the daily, off of that high, that would be like, here's the down cycle up, and we went down cleanly, and it's just a corrective bounce.
Mm-hmm.
And
it's not up to the trend line off those two highs either.
No, you want me to take it from there?
Would you? Yes.
And connect it
That
here?
one? Yes.
Wow.
See, it's not anywhere near up to there though.
No, and even if we did a second one here to here, then it's through it.
Yeah.
The secondary, but that's just this leg. That's not the overall move.
Right.
So I think Amazon, there sits the 200, and I think that matches up with one of your Sunny Bands as well. Oh,
Yep.
It matches with your 200. Yeah,
Right.
There you go. Because your 200 is also sitting at 112, I think, in Amazon.
Correct.
And then it was the Sunny Bands was saying, oh, that's a tractor line.
Mm-hmm.
So it would be attracted. Now, having this thing jump 10 or 11 bucks on earnings, that's not a great surprise.
No, I feel that gap too.
Exactly.
Mm-hmm.
Right here.
Yeah.
So I mean, all that
So
can
that
happen.
would be
But again,
perfect.
I think they're finishing moves, not the beginning of something. I think it finishes and sets us up for the next decline.
I think I agree with that.
So, and then the last one, Jim, was Google.
Google.
Mhm.
Google is showing strength, but at the same time, weakness, like right there. Look at that gap. And then they went back and filled it. Now, here I do have a little bit, but that was all built for the downside of where Google could come in on the downside, thinking that this was going to continue. But I'm going to take that off because obviously that's not happening. But again, we could be in, since we didn't break that. Here is an A, then we get an A, a B, and a C for a flat, and then we get one more upswing, or that was the low. We didn't break it yet. That's wave A, wave B, and this is a C wave up, and that's 1, 2, 3, 4, and we're in the fifth right now. So 104, 105, sure. Their earnings better be stellar. And they may be, because who is it that's suing Google because of their ad policies, their ads?
Yeah,
There's
but
somebody out there.
the big joke there is they're suing them, and now that ad revenue is tanking. So
Right. So, I mean, that's the big thing. Because a lot of that ad revenue is, of course, through YouTube.
Yeah.
Which Google owns.
Yeah.
And I have to say, they're very faithful, because I do have a monetized channel on YouTube. And it's very lucrative. So yeah, I would be a little disappointed.
yeah,
if
YouTube
ad
is
revenue
their best thing nowadays, seems like.
Yeah.
Well, they're saying that Google is a monopoly.
Yes. Yes. Which actually right now they are, because they have YouTube.
Yeah.
Right.
But Microsoft is spending all that money with the AI to get their own Alexa going or whatever. And if they could make an effective thing on that, that could be some competition down the road too.
Right. But don't forget, this is something else that we didn't mention in the earnings things. We got Metaverse reporting on Fed Day. We got Metaverse on Wednesday.
Yeah.
It's totally going to be muted. But what they're really banking on is their ad revenue.
Yeah.
People are looking, well, yeah, maybe Metaverse is going to show an improvement in their ad revenue, and I don't think so.
Yeah. Let's look at here's what I think would be very helpful to people, because again, where the stampede has come, the big question would be on people's mind is has it come too far? Is it done? I mean, because you got Europe up 10% for the year. You've got China up like 15 or 20% or something like that. Baba's gone up 87% off the low. But let's go over some of the broad-based ETFs so we just get a flavor for the entire sector. Let's start out with EEM, and I'll do a few with you, and then I'll switch over to Sunny for a few. Let's look at EEM. This is your emerging markets, and the longer term charts, appear to still indicate it's a throwback rally.
Right.
But is there anything that would tell us that somewhere in this neighborhood?
I'm looking at the you and I looked at that one other time because I put fibs up there. This is the weekly.
Yeah.
It's a recovery rally, and that's it.
Yeah.
So if I had to really, let's go back and let's just put some simple fibs up there. Very simple. We're going to go to that high. We're going to go to that low. So it's not doing anything.
Right there.
Right. 42.96, Jim.
Yeah.
And then you got the 200 sitting above it at 44.30.
Yeah.
So I think we're reaching its completion point, as we're reaching in the S&P, as we're reaching in the NASDAQ, et cetera, et cetera, et cetera.
Well, why don't we put up China, FXI? Of course, EEM probably is primarily China anyway, but.
Same.
Yeah.
They're all mirroring one another.
Yeah.
So it tells me a lot of things. It tells me the narrative was a false narrative, whether, but as it was playing out, absolute true narrative.
Yeah.
But the reason that it was all getting hyped was, Fed's going to pivot. China's in a recovery mode now, and we're seeing them pump a bunch of money. They're doing a lot of stimulus to, get their economy going, and that may all be true.
Yeah.
But what we still have not seen is the proof that it's working. Other than we're all jumping back into their markets, but is it actually going to come back out in their economic calculations and their numbers? So I think here on this one, there's still room, but look what we got right in front of us, 33.73. Then it
could be a deal. February could have some vulnerability to it. Huh?
Yes, absolutely.
Yeah.
And again, if it comes through, this to me looks like an ABC against a 5. So what's that tell me? There's still another 5 down. And that's something that I'm noticing here about our own country, about the United States. I think we've, if we look at our own interest rates, we've done in terms of bond price, we've done a quick 5 down, and now we're doing 3 up. What's that tell me? We still got another 5 down to come. And what's that suggest? Lower bond prices, higher yields. So
With
interest
the
rates,
China reopening, that's a tremendous amount of demand hitting the market. The unemployment rate's 3.5%. If the employment cost index is still in the 4 or 5% range, there's a lot of pressure. And then, of course, energy is doing kind of lousy today, but there are some people who think that the supply-demand dynamic there is going to catch somebody by the ear at some point. And so there's a lot of vulnerability for the inflation to be a lot more sticky than people are anticipating, and the Fed to definitely take their time doing anything dramatic with interest rates.
I just want to show you real quick. This is the 30-year.
Okay.
I want to go out just to briefly show you. Here's what the yields have been right now, because we got that first meeting coming up on Wednesday. The yields in the 30-year have hung out 3.6, like the 10-year 3.5, absolutely 3.5. The 5-year and the 2 around closer to 4, but this one around 3.6. Now bringing this back down, you can see pretty clearly the labeling, right? That was an extreme, so I don't count it. If I go over and I just use a closing base on my chart, you're going to see that was the high. That was the yield low, and the bond price high was in August of 2020. Then we've come all the way down in a very clean 5. That's only just in wave A. This is a B wave. We still, now get this, here's the kicker. We can see bond prices continue to rise. Now, so again, tomorrow, Wednesday's got a lot riding on it, because we're sitting here. Either this is all done, and I'm going to put a B up here somewhere, because if it is, we're in deep. The bond price in the 30-year is going to go under 100. And it'll do it real quick.
People are making a good point that you're really not getting paid very much for duration risk. In other words, 30 years is a long way from today, and you're only getting a little bit over 3% in an environment where the deficits are this big, where the amount printed has been so tremendous. I mean, they're just saying it seems inordinately low for duration risk. It's almost like people are thinking in the next 30 years, there's going to be absolutely no problems.
Right now, we're looking at, if this thing gets itself up there, then yes, we could probably see 3.25, where then we're done with this B wave. But here are interest rates. They did 5 waves up. Now, if this is just going to be a 3 wave down, right? Because we're doing the opposite of what the bond price does.
You will go down towards 3%.
Maybe.
Yeah.
I have a lot of market players who are very, very active in treasuries, and they're like 3.25, they don't see. I'm like, well, that's a possibility out there, whether you see it or not. But here's the other part. If I just kind of run.
It's almost like they forgot about duration risk, because if they look at their bond portfolio from when you talked about it in 2020, and you look at the value of the bonds then, the value of the bonds in October of last year when we hit 435, that was a fantastically large loss that they have. And when you have a big loss on a 30-year instrument, you have to wait 30 years to get your principal back.
There you go.
And I don't have 30 years left.
But what I'm trying to say is you're kind of in a jam, because that's not going to swing back the other way unless rates really drop. So the bottom line is they seem like they've had amnesia on what kind of losses can occur if, in fact, the bond prices, lose their value again.
I just put up a monthly chart of the bonds and put a Fibonacci line on it, and it looks, I mean, we're right at the 200-month low. We've just bounced up off of that. I think we're going to 132 and then back down to 101.
Right. And that could just be the ABC. Longer term, which, Jim, again, we're talking about that we're going to be in this correction, even within the bonds and this inflation, and we move into a period of deflation, et cetera, et cetera. So we had a lot of things going on between now and 2024, even out to 2025. So if we're looking at this just on a yield basis, here's the targets. 6.5 to 8. Now, that's going to blow people's minds. And when you're thinking that the low on this yield was 1.17. So what's it going to take for this thing to really kind of push through? The secondary drop in terms of rise in inflation, drop in bond price, rise in yield. So again, 5 up, I do 3 down, I got another 5 up to do. So there's still a lot of danger out there. So, and again, if they kind of keep that in the back of your mind, this folly of what we're doing, it's a recovery rally, no doubt. But don't fall in love with somebody telling you it's the new bull market.
Yeah.
And this is one of the main reasons why the international markets have taken off and the semis have taken off, is because of the back off in yield. The other reason is the dollar had a big drop. Let's look at the US dollar, because if that is done with its going down, that's a problem too. And 75% of the advance of last year was already taken away. So it's a pretty big chunk of last year's run taken away.
Big chunk. But guess what? It's kind of done 5 down. I'm looking for 3 up, and then it's got 5 more down to do.
Yeah, but it could have a bounce from here, which of course in February would be negative for international, negative for the semis, negative for all the tech stocks that went up. So that might be our reasoning here why A, if yields go back up at all, or B, if the dollar has that rebound you're talking about, then because one of the most crowded trades in the world is long the euro, isn't it?
Yeah.
And so the bottom line
also,
is,
and then we take a look at the Bund. The Bund still has a little bit of, like for bond yield, it still has a little bit of more upside before it starts to come back down. So all of our interest rates markets globally are pretty much in alignment. And so we're just watching them all climb that wall of worry, so to speak. And it's just going to do a flip, and it's got another large decline. The dollar, on the other hand, I was thinking that this actually would turn into a finishing rally, getting it back up to 120, which just takes us out to previous highs.
Yeah.
My long-term chart shows the dollar going down to 98 to 100, right in that range.
Absolutely agreed.
There you got a 61 number there, so there's no question. But that is only a couple of points underneath the low that it made.
Absolutely correct.
It's not like there's a huge move. Seems like it's already happened,
Yeah. So if anything, we get a bounce. We're still going to reach that target, Sonny. I agree with that target totally, because I was going to point out I got 99. I got the 200 sitting also at 99, and a little overthrow 98. Not out of the picture, not at all. So, but I think we might get a little bounce up here, maybe back to 106. And then, Jim, this is what you were saying comes into play. A dollar rally?
Yeah, I mean, anybody who's long tech, anybody who's long Europe and long EM, they're long because of the yields were dropping and the dollar is coming down.
Yeah.
So, and the amount of people that are positioned now, long EM, long Europe, long China, long anything like the euro or the British pound or the yen. I would think that the positioning is a little bit crowded in that direction right now, short term.
I agree. This is a prime opportunity for you, called the options professor.
Well, this is where if you had gains, you'd start selling calls, or you do collars.
Here you go.
Buy puts. Obviously.
There you go. That was the perfect lead in.
Yeah.
You're absolutely correct.
Or replacement trades. You get out of the long position you have, and you put a limited risk call in there, or call spread, just in case it's going to keep going. It's kind of like you take $1 out of the market and you put 25 cents in to hedge in case you're wrong.
Right. Yeah, I like both of those. I really like it. I'm glad I mentioned it so you could put that in.
Yeah, no, and this is why you need to learn about it, so it's not a foreign language to you.
Absolutely true again.
And I'll tell you one thing, the brokerage firms, they don't talk about hedging too much. They're generally into buy, and if it goes down, buy more, and if it go down, buy more. If it goes up, buy more. Basically, it's buy more all the time. You know what I mean?
Right. You're in it for the long haul.
Yeah, the long haul. And like I say, this is another reason why these markets have to swing. In other words, last October, if that would have continued going into the end of the year and the beginning of the new year, there'd be no pension funds who'd buy any stock,
There you go.
and there'd be nobody who'd buy bonds. So you can't have that kind of a situation. Plus, you had the European pension funds were in a catastrophe, and the emerging markets were talking the word default. So that, you don't have to be a genius to figure out that they're going to have to ease up on the dollar, and they're going to have to ease up on our interest rates so that, obviously that everyone can catch their wind. Well, they certainly have caught their wind in the last 4 months, huh?
They are absolutely
Not only
true.
have they caught their wind, they ran 100 miles an hour the other direction now.
Yeah, true again.
So,
And a lot of it just on, I think it's like, and again, I'm going to go to what you call yourself, the options professor. I think so much of this rally that we've seen, and I shouldn't be having gold up there because it's not the same thing, but that we've seen is courtesy of the rally, the strength that we've seen in Tesla, the strength that we saw in Microsoft, the strength that we saw in NVIDIA and Netflix, just all getting pushed in one direction. And it was all wrapped around a Friday expiration.
yeah, exactly. Yeah. Very much order imbalance. Yep.
So, when we got that going on, and then somebody's spinning going like, well, everything's bullish. It's like, no, it's not. Don't attach that to it. It's all options. It's all derivatives play. And that market has exploded beyond everybody's imagination. So,
Tesla did go down about 75% in value in about a year. So when you go down 75% and you're supposedly the leader in EVs, you're going to have somebody who was short. And, if the word gets out that, something positive happened, it's going to go bounce from 100 to 170 because, these people are, again, when the algos feel or get an idea that the one side of the market has no volume.
Right. I want to show you something.
They're going to hit that offer side and bid the thing up because they know nobody's left to sell.
I want you to, this is today's volume. These are the options that are expiring on Friday.
Yeah.
Almost 100 volatility. The volume in the stock, 171 million. Folks, that is huge. I don't know what the float is in Tesla, but I know when you start getting close to 200 million shares, you're doing a chunk of what's outstanding in the stock. Now here we got, look at that, the 180s, and then we got the 200s. Where's the volume today? In the Feb 200 that expires on Friday.
And like I say, again, it could easily go up to that level because, again,
you're absolutely right. Look what it did last Friday.
When a stock goes down as far as it did, down to 100, it's in no man's land, really, technically, because all the moving averages are up at 200 and 220 and 240. You know what I mean? And so obviously, you can bounce a heck of a lot when all the moving averages are, $40 and $70 above the current price, right?
Right. The 200 moving average is at 232, and the trend line across the tops is at 250.
Yeah. So that's why, like I say, this is a reversion to the mean trade if there ever one was.
Absolutely true. Thank you for bringing that up because that's exactly.
And those aren't bad trades. You can use the short-term indicators to get your entry levels and maybe your stop points, and then you can keep it on a short leash. And if it starts to make that reversion trade, as you can see, it happens very quickly.
That's weekly though, isn't it, Michael?
This is the weekly.
Yeah, but if you just put a
somewhere else.
It is, you're right. The 200 is way up here. Yeah. Oh, that was the line you were mentioning. This one. Oh, okay. Yeah. Because on that weekly, it's the reverse. It's the 50 that's sitting.
Right.
Yeah.
Let's take a look at two more real quick, you guys. One is gold, which you mentioned, because when it hit that 1950 mark, it started to stall a little bit. And there is I saw a little bit of a gap on one of my 5-year graphs between 1825 and 1835. And I was wondering if you could see a correction down there to fill that gap, Michael.
No, I do not. The interest in gold remains very strong.
Uh-huh.
And it's not necessarily coming from jewelry makers, or we've seen, like the countries of Indonesia, a
Right.
lot of countries where they are collectors of gold. They like gold jewelry. They have a lot of people that refine it and make jewelry, et cetera, et cetera. So that remains strong. But where I'm seeing this buying come from is central banks.
Yeah, no, there's no doubt there's been a huge central bank. My point is if you look at A, the RSI, B, the idea that the dollar does bounce, yields may bounce up, then this would be one of the trades that everyone has piled into where you could maybe get a little bit of profit taking, and you got a 1825 number there. So this could be a February dip. This could be a February dip potential.
Right now, the price of gold is at an attractor. It has fallen back from the attractor that's at 1948.4.
Right.
Yeah.
And I think we're going to drop back down to at least to the DMA, which is at 1906. And I think we're going to go on up some more.
Yeah, no, yeah. It's just,
but I didn't mean that it would never happen to the level you were talking about, Jim. I just think it's not going to go and fill that. I do think we pull back.
Yeah.
But I think our next stop is 2000.
Yeah, I agree with that.
So,
After a
and
pullback.
then
on a short-term basis, though, if we were to start closing under 1920 and 1910, would that be some kind of a short-term signal of weakness?
I
got some moving averages on a short term that's coming around 1923, which is where we're trading right now. So it's really right into some support actually right now.
I agree. I don't know if it necessarily is going to be a sell signal as much as it might be a buy signal.
Yeah.
Yeah. So what you're saying is forget about the sell side. If just buy the dips is what you're saying.
Well, but a little bit tighter than just saying buy the dips. I think there's specific reasons to, and I think you got to you plot the correction so that you're not getting into where they're going to drop it another 10 or 20 bucks, and you're being going like, what did I do that for? So I think if you plot your entries and you are a gold trader and you are looking to get long or add to a long, then yeah, that's how you're going to look at it. If you're just day trading, then absolutely, I'm with you, Jim.
Mm-hmm.
You're playing all of it.
Yeah.
So you're going to want to sell it.
Yeah. And like I say, or if I was a discriminating buyer, I might keep my powder dry to see if I get a better opportunity down there. That's what I was thinking. Let's throw up that. So I think we got the gold down pretty good. We got a bull market going on. And the question is will we get a drop? And if the dollar were to pick up steam and if the yields rise, then you got a better than even chance you'll get that kind of a better price. If not, if they come out dovish and the dollar starts going to 99, I mean, you're probably going, on the
right. Right. Here's the caveat. Silver. Talk about something that's stalled and having trouble and not being able to get itself anywhere.
Yeah.
Silver. And I don't like the pattern. And I have to take away because I don't think that's what's happening anymore. But this, I think if it cannot hold these levels up here, and those are pretty high, but there's the 20 is sitting at 22. We stand a chance that we're going to break below 17. If it starts to come off and breaks below that 200,
yeah,
I think that silver can easily come back down and finish up a down cycle and end up below 17.
Let's try to hit two more because we're coming down to the end. I want to give you guys time to talk about what you can do for these people. Let's talk about energy, crude oil and natural gas. I mean, natural gas. I mean, I heard guys on CNBC saying last fall that natural gas was going to be this explosive move and you couldn't get it. And it's dropped 75% in value.
Mhm.
Right.
I mean, this is called a widowmaker, You ever want to see what they call a widowmaker? There's your sign right there. Widowmaker.
But I have to say, if we take a look at where the high was, August. You're a user, you're an energy company, and you are anywhere around the globe. And now you've got to get enough. You've got to purchase enough and put it in your storage.
Yeah.
So that you can get your area through the winter.
Yeah.
Are you going to be buying now or are you going to be buying before? That's why we see it spike over the summer
I
months.
find it a little bit interesting down here, of course, with some of the natural gas stocks, but the one because the whole world is long energy stocks. So let's put up crude oil there and maybe XLE and give people a little idea if they're holding on to a time bomb or not, because I've seen that the oil cannot get above 83 bucks a barrel and it cannot get above 93. So these $100 a barrel things can't happen unless you get through those numbers. So this could be another widowmaker in the process, you know?
Yeah, I agree. This was for a pullback that exceeded. So if I just leave up those fibs, which should have shown where it should have come down to and then rallied again. It didn't. But that doesn't mean that this is not an ABC. So I think the C wave is extending. We've now come down to, again, this is my weekly, it's come down to the weekly 200. And it got a shot, and believe it or not, it's got a shot at getting down to 62, 90, 63 before it starts to mount a very sizable rally.
Right. Yeah.
Now,
And if you look at XLE, let's see what that looks like. Because I mean, that thing, you know, I mean, Chevron just said they're buying $75 billion of their stock back. So apparently they're not looking for oil. They're using the money to give it back to all these people who hung in with them back in 2020 when they looked like they were going out of business.
XLE just continues to amaze me simply because
there's a divergence on the RSI a little bit, isn't there?
Very little.
Yeah.
But you're right. You can see it again, the weekly. If I bring it down to the daily, it's just showing you, look at that.
Yeah.
I don't know. Yes, I do. No, I don't. Yes, I do. It's just,
yeah.
It's pure chop, which tells me it's corrective and it's actually got another leg down to do.
Yeah.
If I look at the daily, now if I look at the day, I look at the weekly, it's in an uptrend.
It's a very crowded trade. I mean, the entire planet, you can't find one person who is saying don't own energy stocks. So that's always concerning.
Yeah, I agree with you. When it gets too crowded in the room, it's time to leave.
And the red bars are starting to come around.
There's the fibs. If we're looking for a down leg, there's your levels.
So where is your levels? Let's take a look here on this one.
Right now, I'm gonna open that up a little bit so you can see them. Right now,
61 takes you down to 85 bucks.
Yeah. And then if we're going to go 100%, we're down at 81.
Yeah. But 85 certainly is not totally out of the question. It's only $5 away.
Right. No, correct. Very correct. Yeah. And the 200, which is usually pretty stable, right? In terms of controlling things. If they start to pull it off, this will go flat. And it should start to go flat right about where it is.
Yeah.
So you look at that, should be support. And what's it be? A, B, C, next rally. Because that was strong, but that was even stronger.
All right, Sonny, I got to bring it over to you. If you want to put up your Sonny bands so we can take another look at those. And again, when people contact you, you're obviously going to explain how your technical analysis, that proprietary Sonny bands works for them. But what else do you have for them that you want to announce?
Not only do I explain to them how they work, Jim, I do 3 Zoom sessions showing them in the live market how it works and help them install it. I give free trials, free 7-day trials. Anybody that wants Sonny bands, just text Sonny bands to 760-908-3070 and I'll send you Sonny bands.
Perfect. And definitely you should check it out because it's a very unique approach of technical analysis. So it's nice to find something that's not the same as everything else. Michael, again, you know, you obviously have a good expertise in the Elliott wave and the fib area. So how can people get a hold of you and all the stuff that you could do for them?
The easiest way, of course, is to send me an email. My email address is michael@mjf_partners.com. And I always answer my emails. I answer questions. If you can check me out on YouTube, it's Traders Helping Traders and then my name. And so you can look at my work and then also comment, but ask questions in the comment. And I also will answer there. Outside of everything besides doing the daily updates, I do have a trade room and I also do offer coaching.
Sounds good. And as far as optionprofessor.com, our website, you go to that website and put your email in and we can get you 3 PDF reports. One's on hedging market declines and market upsides. Second one is our best stock picks. And the third is a one-on-one hour online meeting with me, where we go over stuff that we're doing and stuff that you're doing, and we try to add our insight to it. So it's optionprofessor.com on that. Okay, Sonny and Michael, I think we went over quite a bit, and there's a lot of value, I think, for people to get a hold of you and find out more. So I hope people take advantage of that. Thanks a lot for being here, you guys. Of course, we'll do this again, and I'm going to send it back over to David.
Thank you.
All right, great show today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. Also, Timing Research updates are available on Substack now. So you can search for Timing Research on there if you subscribe to anything on Substack. So also, you can just go to TimingResearch.com, and the archive for this show will be there as soon as I can get it posted. Also, all the past shows and events are there as well, including the full Tech Wizards event from last week. In case you missed that, you can review that at any time. We did just under 30 presentations, all about indicators, apps, tools, platforms, that sort of thing for trading. So a lot of good info there. And I just want to thank my guests again for today. Sonny Harris of MoneyMentor.com, Michael Filighera of LogicalSignals.com and TradersHelpingTraders.com, and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thank you, David.
Bye-bye.